Good morning, everyone, and thank you very much for joining me. Sorry, I'm a bit late this morning. I had to sort out the technology, and my humblest apologies. Today is Wednesday. It's the 1st of June, 2022. My name's Russell Shaw. I am the Senior Market Specialist at FXCM, and if you can just please take note of my email address, rshaw@fxcm.com. It's the best way to get hold of me. I'm going to just bring up a high-risk investment warning. We're going to go for about 13 minutes here. Then we're going to switch to that crypto minute because I'd like to keep those separate. So please be aware of that. And here is our market commentaries disclaimer. Hey, Katie, good morning to you. Thank you, everyone, for joining this morning. It's highly appreciated. And here's our references: MarketScope 2.0, CNBC.com, and TradingView. I'll just take a look at this chart in a moment. But before we do that, let's just go through the CNBC node. So if anyone's interested, you just go to CNBC.com. There's a little sort of scroll, I don't know what you'd call it, like a scroll bar. Just the one I'm clicking on is European. The European news, and the headline reads: European stocks set for tepid start to June over closing out negative month. And the article reads as follows: European markets are set for a muted open on Wednesday after closing May in negative territory, as traders continue to assess new data on inflation and economic activity. And let me see here. I'm going to skip to this paragraph. Eurozone inflation hit an annual 8.1% in May, exceeding expectations and making a 7th consecutive record high. So we had all-time highs in Eurozone inflation. Investors are closely watching the European Central Bank for hints at the pace and scale of interest rates that are required to rein in consumers. So the next, I think there is a meeting in June. I don't think they're going to go in June. I don't think. You never know. My expectation is they're going to start in July. I think that so they're just waiting to get the asset purchases program done and dusted, then they'll start moving up. So I think July is when we're looking. The question is 25 or 15 July. My opinion is 25, but you know, 8.1% is high. We're looking at headline inflation there. And then the question comes, the next meeting after that, September. I think 50 may be on the cards for September. You see the problem with interest rates. I've had you know, central bank. So we get headline inflation, and then what central banks do is they strip out sort of your volatile items, and they look at core. The core rate in the euro is running, I think it was at 3.8. If I recall correctly, and the obvious question I get is, well, why does the central banks look at core as opposed to headline? And it's because the core numbers reflect the demand side, right? That's what they're stripping out all the supply side influences such as energy, food prices. The central banks can't control that, so they strip it out. They look at the core numbers. So the ECB is going to make the decision based on core, not on headlines. So the headline is running at 8.1, core is at 3.8. They want to get that down to 2. Okay, so the target's 2. So I think 25 basis points is a go in July, subject to correction. I think then 50 becomes an option for September. Fresh data on Wednesday will include May's manufacturing PMI readings from the Eurozone and the UK. Shares in Asia Pacific were mixed on Wednesday as a private survey showed Chinese manufacturing activity contracted in May, though at a slower pace than in the previous month. And the country's COVID-19 lockdowns continue to disrupt supply chains and soften demand. US stock futures were also cautious in early pre-market trade on Wednesday, another choppy session for Wall Street. The Federal Reserve has already given a strong indication of its rate hike intentions at the next 2 policy meetings in mid-June and late July, meaning US stocks could struggle for direction over the summer. So the data that we'll look at this morning, it's quite tricky. I think that some price data has to resolve. I'll show you in particular, I'm talking oil. But before we get to oil, let's just take a look at the US 10-year here. How do I want to do this? I want to also bring up the dollar. So let's start with the dollar. And if we go back to Monday, one of the comments I made on Monday, and it's still very much valid. I'm having I'm having cognitive dissonance at the moment. What is cognitive dissonance? I'm effectively a dollar bull. Okay, I'm effectively a dollar bull. Now, the last 2 weeks has been brutal for dollar bulls, right? So you start now kind of developing a psychological condition called cognitive dissonance. Cognitive dissonance is you discount all the information that is telling you why the dollar is coming down, and you kind of give more importance to the information of why the dollar should be going up. And it's a bad condition. So you've got to think about it very, very carefully. It affects all traders. The best way to think about it is stock traders. Stock traders fall in love with a stock, and when it turns bad, they can't come to terms that it's done a 180. That's cognitive dissonance. So the question here is, what has the dollar peaked? My personal opinion is that it hasn't peaked. Okay, but again, subject to correction. Now, what we have on the weekly chart is we have an overbought condition which needed to correct, and over the last 2 weeks that's normalized, so the overbought conditions are gone. Take a look at stochastic. Stochastic's still looking really strong. It's in that upper quintile. That's where the magic happens, in the upper quintile. Okay, that's the momentum. There's no such thing as overbought on a stochastic. I know that tech will say that those authors don't understand the mathematics of the formula. The upper quintile is where you want to be for momentum trades. Okay, when you're in the upper quintile, you want to keep an eye out for swings to the longs on the long side. We're still there, but not only are we still there, we're seeing that the overbought conditions normalized. In other words, the froth, the ceiling, that's gone. That's gone. Okay, so now the obvious question is, okay, with the ceiling for the dollar potentially gone, are we getting a higher trough here? And that's the next challenge for us. This was the question that we posed right at the beginning of the week, and I'll say I'm having a tough time doing the analysis here because I'm getting sort of pounded by these psychological doubts, and they're still there. They're still there. So I'm trying to be as sensible and as objective as possible. So let's go through to the trading view. Okay, and I think this is a very important chart. This is the US 10-year, and part of the cognitive dissonance was actually that there was frequent posts on social media that this is now a head and shoulders top. Okay, which I can see. You can see it. So here's your left shoulder, here's your peak, here's your right shoulder, and of course, if it's a top pattern, then yields theoretically need to come down. But that's on the daily. Okay, that's on the daily. When we go through to the weekly, there's a slightly different picture. It's a slightly different picture. We've still got strong momentum here. Okay, but let's just work on the daily for today, cognizant of the fact that we're going to have to go into the crypto minute, and we'll continue as we need to. But I'll posit the following potential scenario. What happens if this is not a head and shoulders top? What happens is if this is just a normal 1, 2, 2, 3, right? I think everybody's comfortable with our methodology. 1, 2, impulse. 2, 2, 3. Okay, so we're trying to get the heartbeat. We're trying to get the measure of the market, right? And now Well, if this is a 2-3 correction, if it's a 2-3 correction, what are our patterns for 2-3 corrections? But there's only 3, effectively 4. There's 4. It's either going to be a small rectangle, we call it a ledge, whatever you want to call it, a flag, a pennant, or a falling wedge. Those are effectively your corrective patterns, right? So let me suggest that we look to see if this is a falling wedge. See that? There's your wedge pattern. Now, if this is a wedge pattern, the head and shoulders is still very much on the table. Okay, it's still very much on the table. But what happens if it's not a head and shoulders? What happens if it's a wedge? Now, the way that we're going to measure that, because we can say what we want, but we want to be as objective and as sort of cunning as possible, is we want to look at the stochastic, because the stochastic is on the wrong side. Okay? If there's going to be higher yields, it needs to move to 80. But we've got the positive cross. Okay, that's trigger 1. That's trigger 1. Okay, so now we're going to have to watch this to see if we start moving up. Now, if we move up and we start keeping in that upper quintile, that's where the magic happens. Okay, that's where the magic happens. So there's a lot of work still to do here. I'm not saying this is 100% a falling wedge. I don't know if it is, but I think it is. Okay, we've got trigger 1. We've got trigger 1. Okay, what's trigger 2? Trigger 2 is the trend following indicators. So we use a 2 trigger system. Okay, so we've got trigger 1, the momentum's picking up. What about our trend? Our trend's looking like it's about to cross as well. The trend's looking like it's about to cross as well. That would be the second. Now, even if we get those 2 triggers, it doesn't really mean anything until we get to the upper quintile. But by the time we get to the upper quintile, yields are going to be moving. Okay, you're going to hear it all over the news. You'll hear it all over the news. Right now, though, it looks as if we've broken out of these wedge patterns. These wedge patterns are pretty good to keep an eye on. In my experience, they quite reliable. Not always, but quite reliable. Now, we can't just have technicals. I just want to close this. We can't just have. Let's just close this out the way. We can't just have a technical argument. That's not good enough for us. Technicals. I am a technical analyst through and through, but we've got to understand the fundamentals. We must understand the fundamentals. Okay, it's as simple as that. The technicals must line up with the fundamentals. So the question we've got to ask ourselves is, why are yields starting to move? We must answer that. If we don't have an answer for that, then I don't think we can. I think we're doing ourselves a disservice. We're just going to go another 3 minutes, and then I'm going to conclude here. And the idea here is, well, the Federal Reserve Governor Waller in Frankfurt, he was adamant. I'm keeping 50 basis points on the table until we start seeing we had to move to our 2% target. He also said, I am quite happy to go past neutral. Okay, we had oil starting to move up. Inflation. Okay, so now all these inflationary pressures starting, I think, to freak out the markets in terms of, well, we better get yields back up. So that's what I think's happening now. I said we need a few more bits of price action. What am I talking about? Actually talking about oil. Oil is a conundrum to me at the moment. I'll just bring up US oil. It was moving strongly yesterday, but it was pulling back. Last I looked at it, it was pulling back. That's odd. All right, I guess it's not pulling back. Let me just see. Maybe I was looking at that data anomaly again. Let me just take a look at UK. Yeah, it pulled back over here. So here's a big fall in the UK data. See, this is a daily, right? Here's the big fall. So that kind of caught me by surprise. I'm just thinking, why is that? Is something happening on Thursday? Remember OPEC Plus meeting on Tuesday? Yeah, US oil kind of pulling back little bit there as well. But the trajectories are up. You can see that the momentum indicator is in the upper quintile. Our trend following indicators are strong. I just want to go back to UK oil, which is Brent. Okay, just keep an eye on that stochastic. Now, last thing, because this is going to be important for our next. This is going to be important for our next webinar. Let's just go back to that US 10-year. I see Anna's asked a question. I beg your pardon. Let me just take a look what's here. Was that the EU ban news? So the EU ban news was lifting oil, right? It was lifting oil, but it was coming down quite. Yesterday evening was coming down quite fast, quite hard. I couldn't quite figure out what that was all about. Now, Katie asks the question: what is this? Now, obviously, if I've got this on the chart, what am I looking at here? And that's going to lead us into the crypto minute. So great question there, Katie. This is your correlation coefficient. So I'm taking a look at the correlation of the US 10-year to FXCM's US dollar, right? So I want to see how does the US dollar track to the ebbs and flows to the 10-year. Why do I want to do that? Because I told you right at the beginning, I've got an interest in the greenback. Now we're at 60 here, 0.6. We're at 0.6 here. Okay, so let's just, before we get onto that crypto minute, let's just understand the correlation coefficient, and then we're going to move on to the I'm begging your pardon, my Microsoft Paint's coming up in 2 seconds. Here we go. All right, so this is yesterday's chart. Let's get rid of that. Okay. Let's just understand the correlation coefficient. I think it's a really good tool. Again, correlation coefficients, we need to understand the fundamentals behind the linkages. But there's 3 levels that you must understand with correlations. And correlations, think about it in terms of an envelope that has 3 levels. The top of the envelope, we know, is 1. Okay, the top of the envelope is 1. The middle of the envelope is 0. The bottom of the envelope is -1. What is these? These are measurements of correlation. 1 means a perfectly positive correlation. -1 means a perfectly negative correlation. So let's just understand that number 1 means if you're looking at 2 instruments and they're perfectly correlated, they're going to be moving together, okay, step by step, step for step, step for step, step for step. That's at 1, completely perfect. Okay, -1, Katie, is they're going to be moving completely together, step by step, step by step, step by step, but completely opposite directions. That's a perfect correlation negative, and this was a perfect correlation positive. What is 0? 0 means there's no correlation. Hey Howard, no worries. We're gonna go across to the crypto minute in probably a minute. So just to give you a heads up, thank you very much for joining. The idea here is, Katie, we are somewhere here. We're at 0.6, so we're pretty well into positive correlation territory. Pretty well into So what am I talking? What does that mean? It means that as the 10-year moves, we would probably expect US dollar to move not step by step, but like pretty close, right? 0.6 for every 1. Think about it like that. So that's what this measurement is here. So if this is a falling wedge, if it's moving up, well, the correlation here would suggest dollar benefit. And if it's dollar benefit, okay, give me 1 moment and I promise we'll cut through to the other webinar. I apologies for running late. But if then we go to the hourly, okay, take a look at the hourly dollar. It's on the move. It's on the move. Right. The question is, do we get to this upper quintile? Okay, so that's where we're going to leave it for. That's where we're going to leave it for this webinar. We're going to pick it up in exactly 2 minutes, 3 minutes. So please join me for the crypto minute, which the dollar movement now is going to flow quite nicely into our discussion there. Thank you very much for joining me this morning. I'll see you in the next few minutes. Thanks, guys.